Joining me now is Matt Stuckey. He's the Chief Portfolio Manager for Equities at Northwestern Mutual Wealth Management. And Matt, markets seem to be taking a breather today after yesterday's bounce back. How do you think investors are processing the latest risks here? Not just tariffs and inflation, but now that escalating geopolitical headwinds are on the table, that's another risk that we're going to have to deal with.
Well, good morning, Ali. Thanks for having me back. Yeah, there is no shortage of uncertainty as it relates to financial markets. But the good news is that financial markets have always been pushing through some form of uncertainty in one form or another. Today, it's tariffs and geopolitical uncertainty. But just think about the uncertainty that the U.S. economy navigated in the form of COVID just a few years ago. And so, while uncertainty is constant, market returns are likely to be favorable for investors over the long term.
So how are you advising clients to navigate this volatility, diversify their portfolios, and still be able to capitalize on the momentum in certain stocks out there?
Sure. A variety of asset classes do offer valuable diversification opportunities. Today, it's not just the TINA trade. Fixed income does offer income return that is above and beyond the rate of inflation today. And so that's a useful tool for diversification purposes in investors' portfolios. Additionally, international equities have led this year in terms of the equity landscape. And the reason being is that the dollar's well off its highs, and if that were to continue, you would expect international equity leadership to continue. And thankfully, if valuation is a concern for some of your viewers, those are priced at a significant discount to kind of where they typically trade versus U.S. equities. And so there is a valuation catch-up potential in the international markets as well. And so a variety of different opportunities for investors to embrace in different parts of their portfolio to really highlight diversification as a way to navigate this uncertainty.
You mentioned the TINA trade. For those that are unfamiliar, what is the TINA trade and why do you think that's not the only game in town anymore?
The TINA trade, you have to go back into kind of post-global financial crisis into a period of when the Federal Reserve kept interest rates near zero. There really wasn't a return element to fixed income that investors found palatable for their portfolios. And so TINA stands for there is no alternative, and the only alternative to kind of the low interest rates that were out there were equity returns. Today's environment is different. The 10 years today is at 4.4%. Shock interest rates up or down 100 basis points, and more than likely you're going to have a positive return outcome and into double digits if you do get an interest rate move 100 basis points to the downside. And so, that's what we're talking about. It's not just equities anymore. There's return opportunities across the equity landscape, but also in fixed income as well that investors should embrace.
We've seen weak sentiment in the stock market, yet equities are at or near records. How do you view the V-shaped recovery we've seen since the April lows? Has the strength of this rebound surprised you?
I think if you put this correction in context, it shouldn't surprise investors too much. And the reason being is that, there's only a few kind of categories of, either macroeconomic or geopolitical variables that causes equities to move lower. One is sharply higher interest rates, two is sharply higher unemployment rates, and three is some sort of exogenous shock to the economy. We didn't have higher interest rates heading into the sell-off that started in April. We didn't have higher unemployment that went into the sell-off that started in April. What we did have was tariff risk enter into the foray, kind of with the crescendo of that being April 2nd. That shifted about a week and a half later. And so, the cause of what was pushing equities down has turned into, something more palatable for the economy to digest. And so I think that's why the rebound has been so sudden, is that it wasn't a type of correction that was kind of due to higher rates or due to higher unemployment.
Do you think the S&P 500 has more room to run from here?
Maybe in the short term. I think what's weighing against the longer term, intermediate term in terms of kind of how we view the attractiveness here is just the starting valuation. On a blended forward basis, you're paying 22 times forward earnings for the S&P 500. But for the good news and the silver lining for investors is that earnings estimates are on the rise again. That matters for equity returns. And so, we just are pushing through the end of Q1 earnings, and that has come in better than expected, helping to grind higher, those earnings estimates, which is a powerful kind of short-term momentum driver for the market.
And the Fed meeting kicking off today, we'll have that press conference, that decision happening tomorrow. You seem to think that the Fed could start cutting in July. Consensus is around September. Do you think Jerome Powell is going to telegraph at all tomorrow when it comes to when we could see potential easing?
No, I think Chairman Powell probably won't outline, specifically when he wants to start easing, but I do think he's going to talk a lot about two-sided risks to the economy. One from moving too soon and having inflation moving higher. One, the other side being waiting too late and having unemployment move higher. It's a delicate balance and it's a difficult job. One thing that has been a positive is if you're in Chair Powell's seat, though, is if you look at the last 3 or 4 months of inflation data, it's been near or below actually the Fed's inflation target. The last 3 months of core CPI annualized is about 1.7%. And so that's that's the starting point for when some of these tariff related CPI prints are likely to come into the data. So the starting point, I think, is giving a little bit of comfort if you're Jerome Powell here.
Matt, thanks so much. Appreciate your insights.